Welcome to the Allan Small Financial Show. Thank you for taking the time out of your busy day to spend it with us. We have a fantastic show for you again today. As many of you may know, over this past weekend, I had the pleasure of, playing on the Sunday Money Show, my radio show, an interview I had with the Premier of Ontario, Premier Doug Ford. I had the pleasure of catching up with Premier Ford, I guess, about a week and a half ago, and asking him some really pressing questions about the state of the economy in Ontario and questions about, for example, taxes. As we all know, or many of us know, Ontario is one of the highest jurisdictions for taxes paid by all of us in North America. And what were his thoughts on taxes? Had the opportunity to ask him a few other questions as well. And we're going to play some excerpts from that interview, some clips from that interview. And I think for all of you, hopefully it's kind of gives us some information and tells us a little bit about what our government is thinking or how they're thinking. The other parts of our show today, we're going to talk about what a lot of you are thinking, the questions that you have, questions I've been receiving about what's going on with oil, what's happening with the stock market. Things are going so well right now. Should people be nervous? So as always, we're going to try and answer the questions that we've been receiving from all of you, the listeners, the viewers, about what's going on with the markets. And we try to do this every show, every 2 weeks, provide answers to the questions that you have. So let's see our show topics for today. So we're going to start the show off talking about central banks and inflation. We have a number of charts and graphs to illustrate what's going on. We get a interest rate decision out of the Federal Reserve at 2 p.m. this afternoon. Most people believe that they're going to raise another quarter point. So we're going to talk a bit about that. As always, we have our This Week segment, where I talk about what individual investors need to know before they make their investment decisions over the next couple of weeks. And then we're going to have our Premier Doug Ford interview. We're going to take some clips out of the interview I had with him, and we're going to talk about state of business in Ontario in general, and we're going to talk a bit about taxes as well. Uncertainty about oil prices. That's something that I've had a few questions from investors wondering where oil is going. We've started to see oil prices tick higher, WTI tick higher, Brent crude prices tick higher. What's causing this? We've talked about it before, but the United States really ramping up oil production. We'll get into that. And then we're going to move to something I call market sentiment and a shift in market sentiment. What does that mean? Where is the market going now? Is it still tech all day, every day? Or are we seeing other investments, other stocks, other companies doing much better now in other sectors of the economy? So has there been more of a sentiment shift away from tech? Or are we now seeing just more sectors adding to the fun, coming in and joining the party and really taking this market higher? And lastly, we're going to have your questions, answer your questions, questions that you post. If you have any during the course of the show, please put them into the chat boxes and I will address them at the end of the show. If you have any other questions, perhaps you want to send them to me after the show, I can address them on the next show or during the next couple of weeks before our next show. So without further ado, let's move forward and get on with the show. As many of you know, every time I talk about central banks, I get quite passionate and quite emotional. For me, I just don't understand how central banks can continue to raise interest rates time and time again. I know Federal Reserve took a pause last meeting. It is highly anticipated that the Fed will raise rates 1 quarter point at 2 p.m. this afternoon. So I guess in just under 2 hours from now. And then we're not sure what's going to happen in September. We're hearing that it is a live meeting, which means anything can happen. They could raise, they could pause. Some people think that they're in this sort of pattern where they pause, then raise, then pause, and then perhaps raise again before the end of the year. We saw Bank of Canada go on a pause themselves for a few meetings. And then recently they've raised rates the last 2 meetings. So, where are these central banks going? What is the end game here? It's very very difficult for, I think, individuals to understand what's happening. They're seeing their costs rising, the cost of borrowing money, the costs of maintaining or carrying those loans that they may have, whether it's a mortgage on your home, a line of credit for your business, or whatever it is. Those costs are rising. And in fact, as I've said many times on this show and radio show, a lot of people getting letters in the mail talking about or asking or demanding by the banks that individuals that have a mortgage pay more on their monthly payments. No longer are people able to say, okay, well, just pay less principal and more to interest. Well, right now, with interest rates rising as fast as they have and as much as they have, people's payments aren't even covering interest any longer. And I know the average person out there, at least from what I've heard, they've received a few notices saying that their mortgages or their mortgage payments has to go higher once again. So it's difficult, right? It's difficult for people to understand. And for me, one of the, I guess, things that I get most bothered by is when you hear the comments made by Federal Reserve governors, Bank of Canada, when they say, well, the economy is still too strong, or the economy is so strong, it's so resilient, it's doing so well. It almost makes it sound like that's a bad thing. And so they make those comments, and then they say, well, that's why we have to raise interest rates to cool off this economy somewhat, to bring down inflation. Well, in my opinion, the economy is doing well, relatively speaking. It's definitely slowed from where it was a couple of years ago, but you can actually have inflation come down and the economy continue to do well. You could have inflation come down and have jobs growth. We're seeing this over the past year or year and a half. We're seeing inflation drop quite substantially in our country from 8% down to 2.8%. And as we know, Bank of Canada wants a 2% rate. And in the US, it's down from 9% to 3%. That's a big fall and a big drop. And for those that thought this was going to happen quicker, I don't know why you would have thought that. But to say that the economy is too strong, and so that gives the central banks the opportunity to raise rates further, I think is just ridiculous. We want a strong economy. We want people to have jobs. We want retail sales numbers to look good. We want housing to be strong. We don't want these things to fall. And that is the risk, obviously, that these central banks are taking when they continue to raise rates. They continue to have this mentality that as long as things are strong, we're going to squeeze in more and more rate hikes until perhaps something cracks. Well, maybe we did see a crack in the economy early on this year when there were some bank failures out of the US. I think it was due to the quick rise in interest rates in the US. So in my opinion, I think things have already shown some cracks in the economy, but overall, a definite slowdown. And let's just go through some of these charts. The first chart we have here, we have the federal funds target rate since 2006. You can see on the far right-hand side how quickly interest rates have moved higher. That's pretty much a straight line up. And we're kind of in that range where we were back in 2000, let's call it 2007, 8, back to above 5%. So it's not that the rates are in at around 5%. In my opinion, it's all about how quickly we got there, or the US got there. And we're going to see a chart shortly to show how quickly the Bank of Canada got there as well. And I have another chart here showing US Consumer Price Index. You can see here that the core inflation rate, 4.8%, the headline number at 3%. And really, it's the core rate. It's the core rate here in Canada as well that these central banks are concerned with. Core rate here, about 4%-ish. In the United States, about 4.8% when you strip out volatile energy and oil. I don't know how you do that. As I've said many times, oil prices and cost of energy seeps into everything. If you're transporting goods or commodities or even services, it definitely plays a factor. So it's hard to pull that out when you have a number. But if you were, it's 4.8% in the US. And you can see the next chart, we move over to Canada here, their overnight interest rate versus the inflation rate. Again, we've seen this chart on this show before. And you can see such a large gap, a 5% Bank of Canada rate and a 2.8% inflation rate. And I was actually asked this question over the weekend on the Sunday Money Show. What does this mean? Well, I think it means that if things should turn down, that we could see, or at least the Bank of Canada has enough wiggle room there to actually lower rates come 2024, whenever they decide that they can do that if they need to stimulate the economy. But make no mistake, Central banks over the past, I guess, many months now have indicated that they're not interested in lowering interest rates, at least for the time being. Here we have the next chart we have, an annual interest rate, inflation rate in Canada, I should say, and how it's broken down into many different types or many different areas. You can see mortgage interest costs. That is the highest. Food prices, that's up 9% year over year. You can actually look at all the other items and you can see the 2.8% inflation rate there. And interesting enough, if you look down, you see gasoline. Gasoline prices have come down quite a bit and now show a negative percentage there. So that goes a long way to offset some of these other higher costs that the others bring. I think the last chart, or one of the last charts we have here, I believe that, yes, it is the last chart. We're going to show the rate hike cycle by the Bank of Canada. So we saw earlier chart showed how fast rates went up in the United States. Well, let's take a look at Bank of Canada. Look how fast that red line has moved higher, pretty much higher than any other point in time in recent history, at least going back as long as I can remember. And again, it's not so much where we are at today. It's about how we've gotten here. And there's been some rumblings that Bank of Canada might now be on pause. You know, we've seen headline numbers with a 2 in front of it, 2.8%. Maybe it's time that Bank of Canada pauses and maybe has a little more patience. And that, you know, should go maybe for the Federal Reserve as well. Let's take a step back. Let's show some patience, and let's see where inflation goes in the coming months. And hopefully we don't get a tick up. And if we continue to get ticks lower with respect to inflation, and if we can keep jobs data or jobs numbers strong, I think that's a recipe for success. I'll take a 2.5%, 3% inflation rate with full employment. And make no mistake, the mandate of these central banks is twofold: full employment and price stability. Just seems like central banks are only focusing on price stability these days and not on full employment. So we'll see what happens at 2 p.m. today, and we'll see what happens with the Bank of Canada as we get closer to the next rate decision that they have. So this is the part of the show where I discuss what I think is important for individual investors to consider before you make your investment decisions over the next couple of weeks. A couple of topics here I think should stand out and probably be obvious for our investors. First one, quarterly earnings. We are in the heart of quarterly earnings season in the US this week. It's the busiest week for quarterly earnings that we're going to see. I can't remember the exact number, but over 100 companies will report earnings, the latest quarterly earnings this week. So what are these companies saying? And that's obviously important for how you invest and what you would decide to invest in. Concerns about inflation, concerns about valuation. My apologies. We just talked about inflation. Concerns about valuation. A lot of people are becoming more concerned that the S&P 500 is starting to get a little bit pricey, getting close to 20 times earnings. So we'll talk about that as well. And the third topic, I always have three, portfolio construction. I find myself buying more of the same investments that have been working versus buying some new ideas. And not that we're only buying, we've been trimming a lot of those names as well. But I find that unlike other times where you look to continue to expand the portfolio into new ideas, I just find lately it's buying more of what we currently own. So we'll talk about portfolio construction as well. So let's move to quarterly earnings. And we had two big quarterly earnings after the bell last night, after the market closed. One of them was Microsoft, and we have a chart on Microsoft. You can see how well Microsoft has done. Would you be a buyer of Microsoft here? Well, it's starting to get a little pricey again. Just reached a new all-time high in the last few weeks. And I thought they reported fantastic earnings, but the market actually were disappointed in some revenue numbers, disappointed in their outlook going forward. Azure, which was their cloud business, actually performed quite well, growing in the high 20% range. I think it was somewhere around 26%. Pretty good, beating expectations slightly. So I thought Microsoft was good, but I think when you look at a name like Microsoft, and this is why the quarterly earnings conference calls are so important, you have to hear what the CEO says and what they're saying about the future. And it just sounded like a lot of the money that they're going to be making, the profits that that will come in from artificial intelligence and that part of their business probably won't come for a little bit as yet, that those profits will be delayed. And I think the market didn't really want to hear that. And the stock actually sold off by about 3-4% in after hours, down this morning as well. So this is a stock that you probably want to look at. And again, one of the biggest companies in the world, second biggest in the world, almost $3 trillion market cap. And a name that I think if it were to pull back, people probably would be excited and want to take a look at. A name that's reporting earnings tonight, Meta Platforms, Inc. Meta, formerly Facebook, is going to report after the market closes today. Another name, you can see a chart here, fantastic chart. Had you got into the stock last fall at around $80, $90 a share, you can see how much money you would have made. Many people did, and I'm sure did quite well. We'll see what Meta, what they report. One of the companies that reported last night, Google, or Alphabet, as they call it now, they talked about ad revenue, YouTube doing well, search doing well. So I think Meta, which obviously makes a lot of money with their online or digital ads, I think they're going to do well. What I guess a read through from Alphabet to Meta, I'm looking for a good number today after the bell, and we'll see what Meta has to say, where their focus is. Is it still on the metaverse? You've been hearing a lot now more on obviously the Instagram, the Reels and Stories, but also now artificial intelligence. They're talking about AI quite a bit. So maybe the attention has shifted more towards artificial intelligence. And a third chart we have here on the biggest company in the world by market cap, over $3 trillion, is Apple. And you can see their chart, Apple at all-time highs, once again, in and around $190, $195 a share. What will their earnings, what will they say on their earnings conference calls, and what will they report? They don't report until, I think, middle of next week, middle to the end of next week. So we'll have to wait a little bit for Apple to report, but they're always a market-moving event. So definitely you want to look at these quarterly earnings. You want to look at some of the companies you're perhaps looking at, whether it's technology, whether it's bank, whether it's another sector, and you want to be mindful of what these CEOs or what their CFOs or whoever's on their conference calls, what they're saying. The second topic I have as something that individual investors should focus on before you make your investment decisions are concerns about valuation. And our next chart really sums it up, the valuation part. We have a PE ratio over the years or over time. And this shows you it's US stocks PE ratio. And you can see that gradually, you can see this big sharp increase, I guess, in and around year 2000. And what do we have right after that? Well, we had a pretty big fall for the markets in 01, 02, and in the US 03. But you can see now that the PEs are starting to move higher. So a lot of stocks are moving higher, not necessarily because they're earning more, but their multiples are expanding. And that's not a good recipe for success. We want companies to earn more. And all we're hearing is companies are earning less. They're doing better than they did last year, but they're doing better than the expectation because the bar is set low, but not as good as last year or the year before. So we're seeing earnings come down, yet stock prices rising. Many people are asking why that is. And I just chalk it up to this notion or idea that the Fed is at the end, or the Bank of Canada is almost at the end of their interest rate hiking cycle. And that once interest rates stop moving higher, businesses will be able to gain traction and earnings will start to accelerate to the upside again. So yes, stock valuation is going to matter with respect to your investment decisions right now. You want to find good quality companies and companies that still have room to run and are still growing earnings. The third and last topic I have for individual investors to consider is portfolio construction. And that's something I do every day, obviously. Create portfolios, build them from scratch, build them out of individual stocks, mutual funds, bonds, GICs, income trusts, gold, whatever it is, whatever makes sense for that individual investor based on their risk tolerance and time horizon. And as I said off the top of the show, what I'm finding with portfolio construction is that I'm buying more of what clients currently own, beefing up on some of the names that I think still have room to run versus finding different names. A lot of the A quality names have run. As I said, valuations are now getting stretched. So maybe you look to a B quality name. Well, I've kind of stayed with the A quality names for now and just adding to some of the names that have moved higher, but I think can continue to move higher. I have a couple of names in particular to show. First one is Amazon. Amazon's had a pretty good run this year so far. As you can see by the chart, I think it has a lot more room to run. So even though it's up to in and around $130 a share, I still think this stock can move higher, and I think it will move higher. And it's on everybody's, I guess, wish list or buy list right now that I've seen to start this year. And now we're halfway through the year, a little more than halfway. I still think it's on the focus list and the buy list of many individual investors and investment firms. Another name that, as I mentioned already, that I think reported yesterday, great numbers, stock has moved higher, is Alphabet, or Google as we used to know it as. We've seen the stock move significantly higher, although recently you've seen it kind of flatline and kind of range bound there at the right side of the chart. But overall, Google's another name that I continue to add to for those investors that can handle, of course, the volatility of owning it, for those investors that have the risk tolerance to own it. But I continue to add to names like Amazon and Alphabet because I think these names can and will move higher. So instead of buying something new, I find myself building on or adding to some of the names that I continue or that I've owned for portfolios for a little bit now. And lastly, TD Bank. TD Bank, you're going to see here, has had a nice move higher recently. TD Bank still pays a decent dividend, well over 4%. Stock has moved from the high 70s to the mid 80s, and I still think it has room to run. I think it can go to the mid 90s. Keep in mind, TD Bank has more branches in the United States than it has here in our country. They have ownership in Charles Schwab, TD Waterhouse, obviously, TD down in the U.S. They obviously a big part of their business. And I think when you look at how the U.S., in my opinion, will come out of these interest rate hikes stronger and better, and the economy is resilient as it is in the U.S., I think this is a really good move or a really good source of revenue and growth for TD Bank. So I think owning or building on a position in TD Bank makes sense as well, and something that I would recommend. So overall, these are three things, as I mentioned off the top, that I think individual investors should consider before you make your investment decisions. Lastly, talking about building a portfolio and building on what you already own, I think is important. But yet you can still look to new names that fit your portfolio and diversification. So think about these things before you make your investment decisions and before you choose what you put into your investment portfolio. So that was a part of the show where I guess a treat for everybody. As I mentioned, I had the opportunity and the pleasure of speaking to Premier Doug Ford, I guess now maybe about a week and a half ago, and talked to him about the state of business in our province. I'm sure it's something that concerns all of us. Many of us, if you're not in the province of Ontario and you're watching today, well, you'll hear about from our Premier and what he's saying and how things are going in our province. For those of you that live in Ontario, I think it's very important for all of us to understand what's happening, how his government is thinking, and and what they're focused on. So here's a clip on the state of business in Ontario and what Premier Doug Ford thinks.
That would be great. Thank you so much. So I thought I'd start off by asking you what you feel or how you feel the state of business is in Ontario. From conversations I've had with small businesses, conversations I've had with Dan Kelly, head of CFIB, Canadian Federation of Independent Business, him and I believe that business is sort of flat, sort of stagnant. We had a pretty good bump up coming out of the pandemic, I guess a couple of years ago, but things have really started to slow down, with talk about a possible recession the end of this year or possibly a recession in 2024. How do you think, or what do you think the state of business is in the province of Ontario?
What I see, the business is just booming right now here in Ontario. I'll give you one example. I mentioned all the other premiers. First of all, Ontario is leading North American job creation, economic development. People are investing in Ontario from all over the world, and I'll give you some examples in a minute. But, out of the 60,000 jobs that were produced last month in Canada, 55,800, or let's say 56,000 jobs out of the 60,000 jobs, 93% were created right here in Ontario. That's pretty staggering. And the number of jobs since we've taken office in 2018 is now topped over 700,000. So there's 700,000 more people working today than were working 5 years ago. We just signed two historic deals in the auto sector with Stellantis and Volkswagen, creating thousands of jobs, not to mention the 30,000 spin-off jobs that are coming from Volkswagen alone in St. Thomas, London area. And then down in the Windsor area, thousands of spin-off jobs. And on top of the spin-off jobs, what comes with that is the infrastructure of roads and highways and bridges and schools and hospitals. And it really gets a community thriving down there. We also have seen investments of over $25 billion in the last 2 years here in Ontario. I call it the EV revolution. We're the only jurisdiction in the entire world that have 6 of the top auto manufacturers opening up here in Ontario. And not to mention the tech sector, we've seen, hundreds of thousands of jobs being created there. We've seen $3 billion of investment in life sciences, the pharmaceutical industry, manufacturing's coming back to Ontario. And I get comments all the time from foreign investors or from consul generals from around the world and ambassadors and governors saying, you guys are just going full steam in Ontario. We've cut over $8 billion of burden off the backs of small and medium-sized companies. That's not once, that's every single year. So we're attracting companies. I always say, Allan, government doesn't create jobs. We create the environment and the conditions for companies to come here and thrive and prosper and grow. And when that happens, so do the employees thrive, prosper, and grow. So there's 700,000 more people that can pay a mortgage, can pay rent, can do things they might otherwise not be able to do here in Ontario. We live in the greatest jurisdiction in the world, and I want to thank the people of Ontario, the hard workers in Ontario, to create that environment.
So that was the question I posed to the Premier about what he thinks about what's going on in the province and what he's proud of. Obviously, he talked a lot about job creation, 700,000 jobs created since he took office, 5 years ago, a large number. And you could hear, obviously, the stats that Ontario makes up most of the job creation we saw just last month, for example. But I think, job creation obviously is one thing, people having jobs. But a lot of people will tell me, but yes, I have a job, Allan, but a lot of what I make goes to taxes and paying taxes. And, what can we do about paying taxes? And there's, unfortunately, on the investment side, not a whole lot. So I posed that question to the Premier. What about taxes? We are the 4th highest jurisdiction in North America for taxes, paying taxes. What can the province do with respect to taxes? And here's what he said.
You bring up taxes, and I was actually going to ask you about taxes, so a good lead in there. I know that obviously living in Ontario as I do, and you as well, and especially in the Toronto area, we hear lately about our new mayor in Toronto, possibly raising taxes coming up. But overall, we live in one of the highest jurisdictions for taxes in North America. And so, you couple that with higher interest rates, higher inflation, it's becoming difficult. I know there are a lot of individuals that have told me recently that it's hard to live in the GTA just because of the higher taxes, the higher inflation, the higher now interest rates, et cetera. What would you say to those families, right, that are now at a higher tax rate or will be paying even more perhaps if they live in Toronto coming up? what can the province do? I know you've mentioned a whole bunch of things so far, but I get a lot of questions, obviously, as an investment advisor about taxes. How can they lower your taxes? What can we do? Was there anything we could do? And there's not a lot right now. Obviously, investing in an RSP is one of them. But overall, what would you say to those families that are just struggling with taxes as well as now higher interest rates?
Well, I'm not going to rattle off all the same items I just did, but I'm doing everything I can to reduce taxes. As for the mayor of Toronto and other mayors, a lot of municipalities and at all levels of government, I'll say federal, provincial, and municipal, but municipal is more grassroots. Government does not have an income problem. They have a spending problem. They want to continue spending. When Rob, my brother, and I were down at City Hall, we delivered the first year. We walked in, Allan, the first words out of the city manager's mouth, we have a $778 million deficit. You're going to have to raise taxes 20%. And I said, we're going to drive efficiencies, which we did. We delivered the first year 0% tax increase. We saved over $1 billion for the taxpayers. And I just want to work collaboratively with the new mayor and, try to get this philosophy of just raise taxes on people is unacceptable. And I go back again to the federal government with this carbon tax. They're adding, to be exact, I said 40 cents, be exact, it's 37 cents a liter to the gasoline by 2030. We need to start running government more efficiently, all three levels. As for the province, we're making sure that people have good paying jobs, more opportunities to grow and be able to buy a home. But it goes back to housing as well, Allan. We have 504,000 people, the fastest growing region in North America, bar none. No one even comes close. Last year, 504,000 people arrived in our province, and it comes down to supply and demand on the housing. We need to get homes built, affordable homes, attainable homes, regular homes, and bring the cost down. Let's flood the market with housing, and hopefully it will level off or at least reduce the cost, but we can't do it alone. We need the support, cooperation of the municipal and federal government, and I'd like just once, either level of those governments come up with a way to save people money. We're one of the only jurisdictions, and I've close communication with all the provinces and territories. We're the only jurisdiction in the country that's actually reducing the burden of tax off the backs of the hardworking common folk out there.
So it's nice to hear that we have a provincial government that is not quick to raise taxes. I know a lot of individual investors would be would argue the other side to that. They just feel as though what they make is going to taxes, and you couple that with the rise of inflation. Grocery bills are 9% higher this year higher than last year, and couple that with taxes and now rising interest rates to the point where many people just don't know how they can to live in this in the province or live in big cities such as Toronto or other big or major urban centers. So it's getting more difficult as taxes rise. I know a lot of people have unfortunately decided to leave the province and leave Canada, move down south where taxes may not be as much of an issue, not as high for sure. So it was nice to hear that the premier said that governments don't have an income problem; they have a spending problem, and hopefully he will be able to work with the new mayor of Toronto and other mayors in Ontario and come together and really help individuals that need help individual businesses, especially considering a lot of these businesses have not gotten back to where they were prior to the pandemic. So once again, I want to thank Premier Doug Ford for allowing me to catch up with him and ask him some pressing questions that many individuals in Ontario would want to know the answers to. So thank you again, Premier Doug Ford, and I look forward to perhaps catching up with you again sometime in the future. So I wanted to touch a bit upon higher oil prices. We've seen the price of oil move significantly higher in the last week or two, gone from under $70 a barrel WTI to almost $80 a barrel. I know Goldman Sachs, large investment firm, one of the largest in the world, believes that the price of oil will move higher. The good news is, with respect to oil and even natural gas, United States United States has become a very large producer of oil and picking up the slack for countries such as Russia and OPEC nations, Saudis in particular, cutting back oil production. The Russians cutting back oil production, obviously, the Russian-Ukraine situation. The Western countries are boycotting or not doing business with Russia, taking on or purchasing their oil has caused the price of oil to rise. On the other side, you have a slowing down of the largest oil importer in the world, which is China. Chinese economy is struggling to get back on its feet. They are growing once again, but not nearly as quickly as it once was. So there you have the give and take, the push and pull between higher and lower oil prices. You can see we have a chart here of the price of oil up to almost $80, $79, $76. And you can see on the right-hand side, price of oil has started to move significantly higher. We have another chart here showing that the United States is producing more oil now than ever before, really. You know, we're looking at almost 12.7 million barrels of oil per day. And there's been some talk that this could go to well over 13 million barrels a day, getting closer even to 14. So you can see why the price of oil has been low for a little while now. However, with China coming on, continuing to stimulate their economy and continuing their thirst for energy and oil, and coupling that actually with what the IMF said recently, that governing body said that they took up their global growth targets for this year as well. So we're seeing global growth ticking higher or expected to tick higher. We're seeing the second largest economy in the world come out of the pandemic now, fully start to get back on their feet with respect to growth. So that is definitely going to have an effect on oil prices. And I guess taking that one step further, I just hope that this does not cause inflation to move higher again in Canada and the US and the rest of the world. Because as we know, higher oil prices can bring on higher inflation. So we'll see what happens in the coming months. We'll see what happens with production numbers. And we'll see what China does. Because right now, oil prices are moving directly with the economy in China. So what do I mean by market sentiment shift? Well, start of the year, it was all about technology. And everybody was investing in any big cap tech stock, whether it was Apple, Microsoft, Google, Amazon, Meta, or Facebook. The list goes on and on. NVIDIA, the list goes on and on and on. And tech stocks really carried the S&P 500, carried the NASDAQ to tremendous gains in the first half of this year. Well, coming, I guess, into July, we started to see a bit of a shift. A lot of individual investors started to notice that these tech stocks might be a little bit stretched and took some profits off the table. And I guess what benefited from some of those sells and where that money went into, well, it was more maybe the more value names, as we call them, not the high growth tech names, but value. And I think some of that money went into bank, went into pharmaceutical, went into maybe some retail names like a Home Depot, etc. So I think there's been a sentiment shift in where investors are putting their money. No longer are people just buying tech. I think they're buying more of a diversified portfolio. And we've seen examples of this. As an example, here I have a regional bank in the US, PNC Financial, a stock that some of my clients own. Again, you have to have the right mindset, risk tolerance, time horizon, et cetera, to own it. But you can see that a stock like PNC Financial, about the 7th or 8th largest bank in the United States, we call them a super regional bank. You can see the stock has moved higher. It was once in the 115, 120 range, now well above 130 and closing in on perhaps 140. So again, money coming out of perhaps tech or some of these big cap names and into regional banks like PNC Financial. I also have US Bank Corp, a chart of another regional bank, ground zero for the banking crisis that we saw in the US in March, were the regional banks, although these are super regional banks, so very different. These are some of the largest banks in the United States. They are not big money center banks, so meaning they're not right across the country, but they're in certain regions of the country, albeit very large regions of the country. So US Bank Corp, they just reported earnings last week. Their earnings were actually pretty good. And once again, they talked about how their business is on solid footing like PNC, and that they have no worries whatsoever with respect to their loan book. Their assets are going higher, they're not falling, and everything is manageable and doing very well. So, and again, you look at some regional banks, money is definitely flowed into those types of investment ideas. And lastly, I have a third chart here, a stock of Caterpillar, a name we don't talk about quite often, but you can see here, Caterpillar is near or at all-time highs once again, just under $265 a share. It's been benefiting from, I guess, the spending that has gone on by governments over the last few years. It's also benefiting from a resurgence in Asia. They do a lot of business in Asia. But overall, this idea of building construction, building railways, building roads and bridges, and anything and everywhere you can imagine, you'll probably see a cat vehicle there, bulldozer, or whatever you're going to see. And Caterpillar has definitely done well. So once again, we're starting to see money flowing out of tech and into other areas. Now, don't get me wrong. I'm not saying to sit here and sell your technology names, but I've definitely trimmed some of the big winners, and it's really risk management, right? I think you need to trim some of those winners. We're still going to own the NVIDIAs. We're still going to own the Alphabets, the Amazons, and the big tech names, but maybe we just trim some of the profits and we move those profits into some of the other names that haven't moved higher as yet. So I think that's what we're seeing in the market. We're definitely seeing a market sentiment shift towards maybe a little more value and other sectors of the market. So as always, now the part of the show where I get to answer a couple of questions that I've received during the 2 weeks before since the last show, or perhaps a question someone posted today. And so we have a few actually. So here's one. What questions do you ask yourself when you look at a company and before you decide to buy that company's stock? Kind of a tough question to answer because there are a lot of things you can look at. I think number one, it depends on the type of company, whether you look at just simply, what they're earning. You can look at cash flow. You can look at many different things. I think, for example, if you look at a real estate trust, you want to know how much they're paying out, that trust is paying out as a distribution or dividend versus how much they're taking in. Companies that pay dividends in general, you always want to know how much of the money that they're earning is being paid out as a dividend. That will give you an indication how solid that dividend is. But overall, I think you just want to look at the company, look at its management, look at, what's their story? Where are they going? What are they saying in their last conference call? And look at, are they profitable? And how profitable are they versus how much the stock price has moved higher? So price to earnings to growth. The PEG ratio, I think, is a very good ratio to use when you evaluate these companies. So those are the things I look at. I think we have time to take one more right now. I guess maybe similar to the previous question, how do you know when it's the right time to sell a stock? So I talked about how I look at buying stocks. When do you sell a stock? Well, again, I think you can look at selling a stock for many different reasons. One, as I mentioned in this show, risk management. Stock goes up by so much, you want to start to trim some of the profits back, because if that stock were to pull back, well, you took profits at a higher price, which is a good thing. And if it doesn't pull back, well, you're still in the name. So it's a win-win on both sides. But I think you look at a name, obviously, if the price gets too expensive, you start to trim. I think if the story no longer makes sense, you may want to get out of that position. A lot of times you get into a name because it's good value. Sometimes it's a value trap, and those names stay good value for many months or even years into the future. So I think you always want to look at a name. You want to evaluate it. You want to look at how much of the portfolio it represents for an individual client. You obviously want to look at the client, the investor, to see if that name still fits what they are doing. So with that, I want to say thank you to everyone again for tuning in today and catching up with all of you. Hopefully all of you had took something out of the Premier Ford interview. Hopefully you took something out of our show today. And I guess we're going to catch you on our next episode, which will be Wednesday, August 9th at 12 noon as always. And until then, happy investing.